Okay, welcome everybody to episode 56 of the Volatility Barometer. We'll just give it a couple seconds for people to roll in, for my chat to load up so I can see some of the questions, and we will get started. So I'm going to do things in a little bit different order today, actually, because there was one really good question right before I went live. Somebody asked a question about the Wheel of Fun strategy. So I thought that might be a good place to kick it off. At least it's directly option trading related. And then we're going to push back the roasting TikTokers for a few minutes here. So 10 or 15 minutes, we're going to get into that madness that exists on TikTok. I don't know when they're going to ban that platform, hopefully soon. But it might be for good content later down the road. So if you ever see some really good TikTok videos that you think are really funny, especially investing related, of course, and what would really be a good bonus is if it was, say, UVXY or VIX index related, that would be a lot of fun. So if you see some of those, of course, email me. I've got a new email just for this and probably for some other stuff as well. But you can submit that. I'm going to actually just type it in the chat here as well. But it's volatilitymatters@gmail.com. Now that name is something that came up actually a while back when I started my live stream. We were kind of brainstorming ideas throughout the community, and I put out a poll and everybody submitted their answers. And that was one that kind of stood in my mind. Of course, the volatility barometer for me, that is my main volatility index that I created. It's the volatility barometer. So I thought, well, that's a pretty cool name for my live stream. I'll just go ahead with that. But that volatility matters kind of stuck in my head for some reason. So, it's kind of got the double meaning. Volatility matters, as in it's important, but volatility matters as well, that, with respect to volatility. It's kind of a cool title. So I don't know if 56 episodes in, we will change the name, but that's the email. Send your TikTok finance, your TikTok investing to volatilitymatters@gmail.com, and we can have a little bit of fun with it. I'm not an insulting person, so I will try to balance that delicate line of pointing out the lunacy that goes on TikTok, while also at least trying to be respectful, because making videos is hard, putting yourself on camera is difficult, and I respect anybody who's entrepreneurial and who's starting a business. I don't want to criticize people too much, but some of the things they say, they deserve a little bit of criticism. So the first thing that we're going to do is dive into the Wheel of Fun strategy, and I'm actually going to execute a live trade, and I'll just keep it open for a while, and in future live streams, we can just come back and update that trade. So we will get started right away. Of course, don't super chat, don't send me any money. Live streams are always free. You can ask your questions in the chat. But if you'd be so kind, subscribe to the channel, of course, and also always share it with people you think might be interested. If you've got a Twitter following, for example, just retweet my stuff every time you see it. It would be very helpful. That's really how you can best support my work. So live streams will always be free, but it'll cost you a like and a subscribe. So let's get started. Okay, so the question that came in that made me switch up the order here is this one. So I thought, maybe is that it? I'd like to subscribe. That is not it. Sorry. This is the one. Talk about your Wheel of Fun strategy. So I mentioned it a few weeks back in a live stream, and it's something that I've been using for, over a decade. It's a great strategy. It's not something that's incredibly unique, like you've never seen it before. There's slight variations on it here and there. But let's actually get into, first of all, what it is. And then, like I said, I can go ahead and just execute a live trade here, and we can track it as we go. That might be the best way of learning, because I'll have to size the trade. I'll have to make sure that I point out things like stop losses. So let's go ahead and talk about the Wheel of Fun. So this is actually coming from a video that I made. Boy, this feels like 5-6 years ago. Yeah, 5 years ago. Over 5 years ago, this video was made. And it's essentially talking about a very basic option strategy of selling puts and calls and then covered calls to get rid of the shares. So the Wheel of Fun, This is just a title that I gave it many years ago. You'll understand why I call it the Wheel of Fun in a second. But essentially what it is, you start out the wheel by identifying stocks that are either undervalued or overvalued. And I don't really mean on a fundamental basis. Typically, we are talking about price. So if you're talking about undervalued stocks, you're talking about stocks that are maybe depressed recently, maybe there's been a little bit of a market crash, volatility is going to be elevated. That would be starting the cycle with put options. And then if you see things that are overvalued, it's of course the opposite. You would be selling calls on that side and you would initiate there. Considering now in the market, of course, we are seeing some difficulty in the market. So now would probably be more appropriate to focus on the put side of the equation. So that's what we'll start. But just remember that this can be done on both sides. So what you essentially do, sorry, my cat's coming in here. I'm just freshly back from Dubai. I'm now back in Taiwan. My cat doesn't really know what to do here, doesn't really know what to lay down. So you might see her running across the camera and annoying me throughout the live stream. Just ignore her. But what you do here, if you've identified that we are in a depressed area with higher volatility, you start by selling a cash secured put option. Cash secured just means that for every one option contract, that equals 100 shares of the underlying, of course, and that's the multiplier that you're going to be using. So this is sometimes how people get themselves into a lot of trouble option trading, because your broker will, and option contracts in general are much cheaper than holding the underlying shares. So the broker will allow you to take a very large leveraged position. But I always like to do everything cash secured. So it's basically the equivalent of holding the underlying shares, and then you're just replicating it with an option strategy. This is not going to get you into any trouble. But if you were to sell, say, 5 or 10 option contracts, and that's equivalent to 200 or 300 shares, well, now you're 3 times leveraged, and you can actually, of course, make money quickly, but you can also lose money quickly. So you definitely don't want to be doing that. You start with the cash secured put option. And then essentially, 2 things can happen. You can either have it in the money, which you would be assigned the shares and you would now be holding the underlying shares, or it would expire out of the money after the expiration cycle and you just keep your premium, it goes to cash and you go right back to step 1. So this is kind of the start of the wheel, right? But then if you get assigned the shares, now you have to turn around and sell a covered call because you want to get rid of these shares. This strategy is not about capital appreciation of the underlying security. It's about making premium on both the put sale and then the covered call sale, exiting the trade with the option premium. So you're not really worrying about the underlying stock. And as soon as you get assigned, you're trying to actually dump those shares with the covered call. And again, 2 things can happen. You can either be in the money, that would make you lose the shares. Of course, you do keep your premium in all cases, and then you're back in cash and you could circle back over. Or if it was out of the money, you would still then keep your shares and you'd go another month longer and you'd sell another covered call and you'd do the wheel over here. So that's essentially why I called it the Wheel of Fun. You can see what's happening. It's a pretty simple system of selling a cash secured put, probably getting assigned shares, selling a covered call to get rid of the shares, and then you lose them, you're in cash, you keep premium on both sides, and then you repeat the cycle. So that is the Wheel of Fun. Now, there's a couple of things to keep in mind. One thing that I always remind people with something, my cat's going insane. Sorry about that. I don't even know if you can hear it because this microphone's pretty good, but I can hear it. She is annoying. Anyway, the thing you have to keep in mind with these types of strategies is when you are selling a put option, you are not reducing downside risk. So you are exposed to the full magnitude of downside risk of whatever you are selling. The only insulation you have is that really small premium that you collected up front. So it is only slightly more safe than just holding a stock outright and hoping it doesn't crash. So you absolutely need a stop loss for this strategy. But let me open a live trade and I'm going to actually show you what that stop loss would look like. So typically what you want to do is you want to get really accustomed to about 10 or 20 stocks and ETFs that you know well and you know how they move. And then you're just going to go back to the well repeatedly and you're going to run cycles through those 10 or 20 stocks kind of over and over again. So one of them that is typically on my radar, and I think it'll be fun right now because of all the madness that's happening, XLF is something that I trade quite often. This is the financial sector, the sector select ETF. And obviously with the SVB bank stuff, it's depressed, right? This is what I was talking about. You kind of want to target something that's down already. We're targeting the puts. Volatility is elevated, so we're going to get better premium. And now you start. So let's say you have an account of $100,000 and you want to dedicate 10% to the Wheel of Fun. So you've got $10,000 to work with. Remember, one option contract is equal to 100 shares of the underlying. So if you wanted to take, say, 2 trades and just rotate through cycles with 2 different underlying instruments, you're dealing with $5,000 and you need something that is priced $50 or less. So XLF is $30.75 right now. 100 shares of that means that it would cost $3,075 to hold 100 shares. That's our multiplier. So we're just going to go 1 month out. This April, 28 days from now, this is going to work just fine. I have to sell a put option. Now, let's calculate. What am I looking for? I typically target around a 2% gain for these trades. Sometimes you can get more, as I think you'll see, just glancing at these numbers, it's going to be a little more. But of course, a 2% gain, you could just calculate it. You can just do 30.75 times 0.02. I'm looking to collect a premium of about 61 cents, give or take. If I look at this 30 strike, I'm going to bring in actually more than that, 84. So you're going to sell the put option to start the cycle. This is the original trade to start the wheel. This is the cash secured put. Because remember, this contract won't actually require that much capital to open. Toss is telling me it's going to be $625. I have $5,000 to work with. If I wanted, I could open 8 of these. But then that's going to be a highly leveraged position, and I don't want that. I just want to trade the XLF and make money on the puts and calls. So I'm only going to open 1 contract. This is equivalent to $3,075 of margin, and I'm getting 83 cents. So what is that return? Just so we kind of keep it in mind. 83 divided by, if I get assigned at 30, so I can just do the 30, I might get assigned those shares. That's a 2.76 return for a 28-day trade. So you can see that this kind of does add up. A lot of people look at it initially and they think, well, that's not very much money, 2.8%. Well, if you did that 12 months a year, obviously it's good. And then you can do 2 trades with your capital, so you can ramp it up there. You can do multiple layers if you want. You could divide it any way you like. But there are ways to ramp up the rate of return. But the key is you don't want to bite off too much because you are not reducing the downside risk. So you have to always keep in mind that this is a slow, patient process that you want to go through. You don't want to jump in and try to get the maximum amount of premium possible. You want to give yourself a little bit of space here. So I said that I wanted to do a stop loss. And what I personally do is a 10% total value stop loss. So if at any point in this trade, whether it's within the first 28 days or whether it's on cycle 3 or 4 months from now, if at any time my trade in total, including all the premiums that I've brought in, has lost more than 10%, I close it where it's at, no matter what stage of the cycle, and I'm out. It's just a stop loss and it's done. Because like I said, you are on the hook for all of the downside. If XLF drops 50%, you do not want to be in this trade anymore, obviously. You don't want to lose 50%. So I cash it in at 10. Well, what would that look like? Well, shares would be at 30. So that's $3,000. 10% total value stop loss obviously is $300. So you can see this pink line, that's the daily profit curve. If at any time this trade is down $300, which is right about there, I'm just going to have to bail out of the process, save my capital, move on to a new target. I'm not going to stick around and suffer excruciating drawdowns with this trade. This is a month-to-month. I don't like to use the word income trading with options because that does not apply to option trading. It's not like a steady month-to-month thing, but this is not some type of underlying capital appreciation trade. So if it crosses this line, I'm out. And I just keep track of that 300. At any stage, that's all I'm willing to lose for this trade. And that's it. That's the trade. So this has 28 days. If the price, which is right here, as you can see, if it expires at 30 or above, nothing happens. I keep my premium. I would go to cash. I would not be assigned any shares, and I would just look for a new target, probably the same target, right? That's what I said, going back to the well over and over again. Sometimes I can sell the same put option several months in a row and not get assigned, and you can just collect those easy premiums along the way. If it expires below 30, I'm going to be assigned at 30. So if it expired at 28, I'm going to hold the shares at 30, not at 28. If it expires, because I sold the 30 strike, so that's what I'm on the hook for. I would still keep my premium in both cases. I get my 84 cents, but I get assigned the shares at 30. And then what I would do is if I had the shares, I would go on to the third stage where I would be selling the covered call. So that would look, you can see the calls are, let me click that. See the calls are over here. At the money calls right now are paying over $1. So if this thing expired exactly at $29.99, that would be great. I would get a monster covered call to get out of this trade. And that would be a very profitable 2 months. But you just sell the covered call when it comes up. I don't know what the price is going to be 28 days from now. But that is the trade. It's fairly simple. Right now it's a put. It might turn into shares, it might not. But I know for sure I'm going to get my 84 cents. So all I would do is I would go over to XLF, 28 days out. I'm going to sell one of these. And I might as well review what I call the 30-second rule while I'm at it. So what I would typically do, you can see the price, 84.85. I do want something close to the mid. Now it's at 86. Now I'm selling a credit, so I want a higher price. So I can go ahead and say 87, right? There's nothing wrong with saying 87. And I'm just going to send this trade. It's going to go into the queue. You can see I'm trying to get 87 and it's priced at 86. I would just wait 30 seconds. Just be a little bit patient. These are computers. It's going to happen quickly. But just wait 30 seconds, and if it doesn't happen, you simply change the order, drop it down to 86, go for it again. At some point, I'm going to get it. And this is how you sort of guarantee that you're going to get a really good price, right? And there you go. I got 86 cents. So now we can go ahead and highlight this trade. It is live. I will keep this open. Sometimes I like to keep this red one that is not the live trade open so I can see what the premium is trading at. But there we go. There's my Wheel of Fun. First stage, here's my stop loss right around 300 bucks, and I'm off to the races. That's all it is. Now I just wait 28 days. And I don't use stop losses for the 28-day cycle. I am literally just going to wait to see what happens. If it does go all the way down to here, but it doesn't stop loss out, I'm fine with that. I will just sell a covered call. I will build my premiums over time. And at some point, I'm going to get out of this trade. So there you go. That is the Wheel of Fun. We will keep that thing open and live. That's the point of the live stream account there, that we can just, anytime you want me to do a trade, show you how something is done, just shout it out in the comment section. I can take the live trade, and we can leave it there for a few weeks. So, you know, we'll come back in 28 days. 1 month from now on a Friday, we will come back and do a live stream, and there you go. So that's the Wheel of Fun. Now, should I do a couple of the comments, or should I rip over and do the... Let's do one TikTok video, because one of them is investing related. Let's start with that. Okay, so I do have to say right off the bat, though, like I said, I'm not here to actually insult anybody. We're roasting people because they're quite roast-worthy videos, but I'm not trying to insult anyone. And for the first video, I do have to preface this one because it is a little bit unsettling, jarring, I suppose, to see somebody giving financial advice when they're in the bathroom doing makeup, or all the other things that sometimes you see on TikTok videos. I remember a couple of weeks ago we did this. We roasted another person, and I said that if your financial guru is in a sweatsuit sitting on the floor, you know, it's probably not good advice. This one today, yeah, they're not screaming a bunch of green flags here for financial guru, but I'll show you what I mean in a second. Apologies, I had to watch it. Somebody sent it to me, so I'm going to make you do it as well. You're going to do it with me.
People who grew up rich won't tell you this, but I had to fight my way here, so I'm gonna spill all the tea. So did you know that if you start investing $75 a week from the time you are 20 years old until you're 30 for 10 years, like literally just 10 years out of your entire life, that is enough to make you financially free, like in the sense that you would never have to work for money again. And maybe you're thinking, yeah, okay, Nicole, how is that possible? Because
Sorry, I have to hold my microphone like this. Yes, I am also thinking, hey, Nicole, how is that possible? That doesn't seem right at all. What she's essentially saying is you can invest $75 a week when you're 20, which great advice. Start as early as you can, obviously. That's fantastic. Start at 20. 75 bucks a week for 10 years, and then apparently you never have to work again. You're just financially free and you literally never have to worry about money again. That's fantastic, but you can't withdraw the money out of the account. So how are you going to live? How are you going to eat? You'd die, wouldn't you? I mean, of course you still have to work until you're 70. The 50-year cycle still requires the job, of course. It's just you're putting $75 a week into a private account that can't be touched. I'm not sure how that translates into never having to work again, but let's give her the benefit of the doubt and keep going here.
because I would have only actually saved $39,000, and we all know that that's not enough to make you financially free. But because you started early enough, okay, compound interest came in, took over, did its freaking thing, and made you rich. That $39,000 turned into $64,000, and that $64,000 grew into over $1.8 million.
Okay. We get the point. So again, money falls from the sky, typically only on TikTok, but it's as easy as that. So one thing I will point out though, this is a little bit alarming. Sorry about the freeze frame. If this girl ever, I don't know if that's flattering or not, but apologies. This video had 10 million views and 1.8 million likes. So 1.8 million people watched that video and thought, that's good advice. I like that. This is great. So to me, that is enough people that perhaps we should fact check this, right? We should see if this adds up because, like I said, she said it in the center of her video. You're probably wondering how that's even possible. I am too. So let's go ahead and fact check this. So what we've got is we've got our standard compound interest calculator. If you're on my live streams, you know we use these a lot, sometimes for fact checking people. But let's get started. So you start at zero, of course, at 20 years old, which is great advice. Start as early as you can. That might be the only part of the video that I like, but that's great. So you start then, we'll leave the return. Capital gains, let's just assume this is done in a tax sheltered account and you're never going to pay taxes. Not even, whatever. We're just going to leave taxes out of it. Obviously, the money is going to be less than that because taxes are a thing in this world eventually, even on the front end or the back end, but we're going to ignore it. Weekly investment, 75 bucks. And the inflation rate, so if we just go into the consumer price index here, we can see that the rolling 50-year inflation is 3.85 right now. So rolling 50 years, obviously inflation is creeping up a bit there. It's in the sixes now for the annuals. And the rolling 50-year is that. So that's just what we're going to use. I'm just going to use exact statistics. These are not hard to find, but 3.85. The only thing we need now is an annual rate of return. And obviously to make a video that's that egregious, I'm sure there's some astronomical rate of return being used here. But typically financial advisors these days, they've always kind of used that 8% number for the buy and hold, long-term, quarterly, annual rebalance, whatever it is. But that 8% number is kind of a reoccurring thing. And a lot of people, to be honest, will roll their eyes at that and say, well, 8%, that's not even realistic. And it's true. It's probably not realistic, especially from today going forward. But I'm just going to be as generous as possible. And I am going to use that old financial advisor. Your pie chart, buy and hold, will make 8% per year. It's a good return for those, indexed type things, but we'll see. Now, remember, she said that this will make $1.8 million. You'll never have to work again. You'll be completely financially free. Here's the end of the 50 years, and let me update these numbers because I never auto-calculate. 605,000, but we have a problem because she said in the video, remember, you only do this for 10 years. So I'm going to scroll down to year 10. this is another part in her video that she was actually correct on. Starting after year 10, you don't have to add any more money, right? You put your 75 bucks and then you're done. You're good to go. So let's see how much money I have following this advice. Well, I don't have 1.8 million. Why isn't my chart updating? Sorry. Anybody who's on my live streams knows that I get the beach ball once in a while. These spreadsheets are extremely annoying. Come on. Come on. It's churning. I don't know if you can see it spinning there. There we go. $228,000. That's what you're going to have after 50 years. So almost nobody starts investing when they're 20. And investing for a full 50 years, that's asking a lot as well. And 8% return is very generous, and we still only have $228,000. So I honestly have no idea what she's talking about. Like that, again, I'm not trying to be insulting, but making videos is difficult and it's time consuming. I know that video was probably only a minute long, but trust me, it probably took her a couple hours. You have to set up the camera. You've got to do a bunch of takes. You've got to edit the thing. You've got to upload it, do all the SEO optimization. Videos take a long time. Is it too much to ask to just take an extra 5 minutes and just fact check it? Just make sure that it's accurate, right? We've got historical data. How long did that take me? 5 minutes to just confirm? Inflation rate is a public number. Choose your rate of return. 8% is ambitious, but okay, we'll be generous here. It took me 5 minutes to fact check this. $1.8 million, that was just like, where does that come from? And I love the part where she says in the video, you're probably wondering, Nicole, where's this numbers come from? Yeah, we're all wondering the same thing. I don't know, but 1.8 million people liked that video, and she's off by a magnitude of roughly 6 or 7 times. So I always kind of cringe at these TikToks. And as you know, I did a live stream just, beginning of January. And I had 6 predictions for 2023. One of my predictions is that TikTok will be banned before the end of the year. And it can't come soon enough. I mean, there's just people being financially derailed left and right on this platform. So pretty ridiculous. But yeah, it's not difficult to fact check these videos. Crazy stuff. So I've got another video. Actually, let's do that now. That's kind of fun. So we're going to do one more. This isn't investing related, but it is financial. It's budget related. This one, I want everybody in the comment when you see it, when it occurs to you, the major problem with this video, go ahead and type it in the chat section. Again, I'll get my microphone. I have to point it down to the screen here. Let's go with this one. Dell the investor.
So this is how you turn credit into cash. Let's say that you need $5,000 cash so you can invest into a real estate project, or let's just say you need cash in general for something you're trying to do. What you can do is you can go to somewhere like Walmart, Sam's Club, and you can purchase some products, let's say $5,000. But when you purchase these products, you want to spend, let's say, $4,000, or you can say $4,500 on your credit card. You can use your debit card to purchase the rest of the products for like $500. And so this would be considered a split payment. Once you split these payments up, you can come back the next day and return all these products. When you return these products, you want to tell them at the customer service, wherever they return these items at, you want to tell them you want to put all the money back on your debit card and you lost your credit card. So what's going to happen is they're going to refund your debit card, all the cash, all that money that you took from your credit will now be put on your debit card. You can go right to the bank, take all that money off, and you can use that cash for what you need it for. But hey, I'm Dale Investor, and I'll teach you how to get rich.
Oh boy. Okay. Has anybody thought about this? I know he didn't. But again, not trashing on him. Dell the investor is an entrepreneur. He's willing to put himself out there. He's willing to put himself on camera. I will always give people credit for that. Again, that video, I think he has something roughly 5,200 likes on that video, which is a lot. I've never had a video that has 5,200 likes. All right, so you're going to require $4,500 for this emergency real estate deal that you just have to get into. You're going to take your credit card. You're going to go buy a bunch of stuff at Walmart, and you're going to split the payment so that you can put the next day all the money back onto your debit card. Now, hopefully Walmart actually returns it. You don't want to go back to the store and have them say, sorry, we don't return, we just exchange, or we just give you a store credit or something. That's going to blow a hole in the whole thing. But it doesn't seem to me that he understands that, first of all, you can just go withdraw cash from your credit card if you want. The bank will give you that money if you'd like. It's no problem at all. This is 2023. But he does understand that if you put the money to your debit card, you still have that charge on your credit card, right? I don't think he's implying that he's going to actually commit fraud here by calling the credit card company and saying that his card was stolen, claiming that the charges weren't even his. That would be criminal, right? I mean, that's jail time. So I don't think he's implying that. But Dell, the investor, doesn't seem to know that you are on the hook for that money on your credit card at what, a 20 to 25% interest rate? You've essentially implicated Walmart in this scheme to give yourself a personal loan at a 25% interest rate. Why wouldn't you just go to the bank and extend a line of credit at a fraction of the interest rate? This one really doesn't make any sense. This wasn't very well thought out. I don't know if that's borderline too harsh, but wow. That's a hard one to understand. So I don't just want to roast people. I want to have some type of lesson. So to Dell here, don't ever invest money that you had to borrow, especially in an emergency, at a 25% interest rate. No successful investor does this. When you want to be successful, you have a long-term mindset. Everything is well planned out. You've analyzed the risk management, you have a plan, you trust the process, you're patient in it, and when the time comes, you attack. Buying real estate is not impulse buying when you see a pair of shoes in a store window. Buying real estate should require more thought than having to get cash so quickly that you have to go to Walmart to scheme them out of a 25% loan. So obviously, this is not true. I mean, when you're getting real estate, there's a reason we have down payments, right? It's to prove that the person has at least some capital and the ability to pay the debt. But if you want to double down on that, not only do you not have the money for the real estate investment, you actually have to borrow the money to even get the down payment. You can't afford this house. Whatever the investment is, you can't do it. So don't ever borrow money for any investments. This applies to all the crypto people who were taking credit card advancements, like Dell could have just said in his video. You can just go to the ATM and get money if you'd like, but don't buy crypto on credit. Don't mortgage your house and buy anything. Investing, don't invest in VTS if you've borrowed the money to have it available to invest in VTS. You don't have the money to do that. Investment money only comes from one place: having a good income, living below your means, saving enough money, and over time that builds to an amount that you can say, oh wow, now I have a chunk of money, now I need to go find a place to invest this money. You don't use your credit card to do any investments ever. If you need the money in one day, that's an investment you need to walk away from. So, Dell the Investor, good video. Yep. That's no worse than my videos. I mean, making videos is hard, but that was not good advice. That was funny, though. All right. So let's just go through the comment section and see if there's any others. I like the one about the Wheel of Fun, of course, because it lets us open a live trade. That was pretty cool. And feel free to ask to open any other trades as well. Let's go through it. So this is interesting. I highlighted it before, but it was the wrong one. I don't like to do ones that are super business related. I'll do it quickly. I'd like to subscribe to VTS, but I'm unsure whether the subscribers achieve the returns you promote. Could you send your subscribers a Google Forms survey? Well, first of all, I don't ask even one personal question about any of my subscribers. I don't know their account size. I don't know their satisfaction level. I've just always made it a rule that I will never ask people any questions about their experience, or it's their business, right? We even have situations where we have Europeans who can't get access to some of the ETFs that we trade. because what's called the MiFID II regulations in Europe, where they can't access things that don't have, a certain filing, a KID document basically, that translates the languages and makes it available. So I have had some Europeans come to me and say, can you please ask some of the other VTS community members what ETFs they're trading? And that might be helpful, but I've tried to put the list together myself because I don't ask anybody any questions. I can't ask this guy a question to help out this guy. So that's a very long-winded way of saying I can't send out Google documents to the community and asking for satisfaction. What I can say, if this helps, is I've been posting my performance on a public website for over 11 years now, every single month, and my comment sections are open. Nobody's ever been blocked. Twitter's never been, no blocking. I have no hater. Well, I have one hater. I had a hater about a year ago. It was pretty cool. I had another hater a couple weeks ago. So I have 2 haters in 11 years. No, I do realistic expectations for investing. I don't do advertising. I don't pull any emotional strings. I've never flashed pictures of cars or watches or money. I don't insert as a millionaire after everything I say like people these days do. Here's what I think about this as a millionaire. No, I don't do literally anything. I trade my own account. I share it with the community. They can take the trades if they like. So that's the best I can do for you. I kind of see what you're asking, like, hey, could we see what other people say about it? But I don't know. I've got a video planned, or maybe even an article. I don't know which one it's going to be. But one of the things that I'm most proud of, and I was thinking about this recently when I was thinking about my pricing, right? I don't like to increase prices. And everybody who gets a certain price is grandfathered in at a certain price. So, and trust me, stay with me here. I'm answering your question. But having a subscription service, one of the easiest things to do these days is to make stupid TikTok videos and get people in the door. That's easy to do. Keeping people in the community is really the most difficult part by far. Just bar none, that is the hardest thing to do. Anybody can do false advertising and show Lamborghinis and money. And yes, people will come in the front door, but they'll circle right out as soon as they realize how stupid the service is. So what I was getting at is, I was just adding it up, and I have 351 subscribers. I have a lot more than, I don't share the numbers, but 351 subscribers who are paying $50 a month. And that means that they signed up in 2016 or before. I've had my service from 2012 to 2023, but in 2017, the prices went up to 80. And then I believe in 20, doesn't matter. It went up to 89. But there's 350 people on $50. So I've got 350 people who are paying me money for 7 years or 11 years, in that range. That's something that I'm very proud of. That it's actually quite difficult to have hundreds of people follow your signals for maybe as long as 10 or 11 years. I've got some OGs from the very first day that I launched still with me. If that matters to you, yeah, I'll probably throw a video together and show a little bit of that. But I think I can gauge that people like what I do. But you'll never know until you try. And remember, investing is a 30, 40-year process. There is nothing saying that if you join a community that you have to immediately start trading your money. There is nothing wrong with paper trading for 6 months. That 6-month period, you're not going to lose very much. You're not going to lose anything, really. It's just a blip in the long-term thing. So if you don't trust somebody, but you think that you want to trust somebody, because we're all online and trust is hard to come by, what would be wrong with just joining a service, mine or somebody else's, and paper trading it? If you see some glaring errors within 3 or 4 months, yeah, you're going to bail for sure. But remember, you're not going to lose much in the long-term process. You don't have to start trading real money day one. So maybe that's an option for you. What's it like to travel with your cat? She's never traveled. I've only taken mine on road trips. I haven't flown or anything. Yep, me neither. Our cat is we're not positive because our cat's mother, we don't know who the father is, but just looking at our cat, we think she's probably a Persian Himalayan mix of some kind. She's certainly a lot Persian because her mom's Persian, but there's something different about her. So she's not a pure Persian. But when you travel with exotic cats, quite oftentimes you have to file a bunch of paperwork. And when they land in that country, they get quarantined for oftentimes a month or longer. So unless you're actually moving, I've just thought, I'm not going to take the cat. We got tons of family and friends here. They just come over and take care of her. If I ever moved full time, which I'm not planning on doing, I live in Dubai maybe half the year, but that's not long enough to take the cat over there. So yeah, it's probably not worth it. All right, Arthur. I put on a couple extra Iron Condor trades, but still following your rules of max 3 positions at 3%. Then March 8th and 9th happened, SVB banking crisis. And then the next question in the sequence, is there any way to avoid front-running a Volpocalypse train? Front-running. I would assume you mean avoiding some type of banking crisis, Volpocalypse 2.0 type thing. There's no way of avoiding it because we're never going to know when it's coming. But of course, when you're trading an Iron Condor, and I can show you, obviously you've seen these, you're in the community, but, there's Del, the investor. I'm going to circle back to, I'm going to watch a bunch of his videos and see if he's got more to offer, because I feel like that one was pretty poor, but maybe he's got other good stuff to share. So you might see Del make a return to the live stream. We've got 2 trades open right now, 2 live. Let's assume we have a third one. Probably next week we'll open something on gold or TLT Treasury, something like that. Let's assume we have 3. All of the same rules apply. You want to have the full rules of engagement. So the only way to avoid getting steamrolled by some Volpocalypse event is to make sure that all 3 trades are diversified with what we call in the community, as you know, 5-point diversification. First of all, across price. You never open trades that are just doubling up on the same trade, right? You want to see some significant movement between the trades. And so that would be diversified. So even if you got hit with an SVB banking crisis, maybe that did stop loss out one of your trades, but it wouldn't do all 3 because you've diversified across a wide range of prices. The second diversification is across time. You notice that these are different expirations. This trade's going to move slower than this trade. So now it's diversified across time as well. The third one is across strategy. In this case, doesn't apply, but you can use calendars as well. And remember, calendars are slightly Vega positive, so they move differently than Iron Condors do. Now you've got a third level. Fourth, across volatility levels. So maybe you open one before the crisis, and then you open one when you get that SVB spike, right? That's kind of how it happens is maybe you'll open one when things were relatively calm. What am I looking for here? VIX index, that'll work. I hate the VIX, but that'll work. Maybe you opened one before the SVB crisis, and then you're going to open one here with that really high volatility. Now you've got another layer of diversification there. And then the last layer is asset class, which we just recently released the video accompanying the Iron Condor course that we have. If anybody's interested, we have it's probably going to be more than 25 parts, but it's pretty long right now. An Iron Condor course that everybody who joins the community just gets access to. It's a bunch of videos, 10-minute videos, covering literally everything about Iron Condors. But another asset class would be the 5th point. So that's really the only thing, not only with Iron Condor trading, but with all trading. All you can do to avoid a Volpocalypse event is make sure that you're a diversified investor, and in specifically to the Iron Condors, diversify across price, time, strategy, volatility, and asset class. 3 levels of trades with 3 different trades within it, using a 50% stop loss and 50% stop gain, but the stop loss being the important side of it. When that premium dips half of what you sold it for, you're out of the trade. One of the reasons we do Iron Condors with such long date to expiration is because that gamma is relatively low. So even if you get hit with something, we do 45 to 75 days in advance. And our Iron Condors very rarely dip inside 30 days to expiration. That stop loss or stop gain will probably trigger before that. Sometimes it dips to 25, but not often. That's all we can do. That applies to every trading. I don't know when the Volpocalypse is going to come, but I know for sure that my portfolio it might not be a fun day. I might lose a significant chunk of my capital as well, but I know that my portfolio is diversified across 5 strategies, and then each individual strategy is also diversified with different assets. So right now we are in utilities. We move to cash, and this one is in cash. We've got a VXX broken wing butterfly that is going to profit from volatility crush. And then we've got 2 Iron Condors, soon to be 3. What more can I do? Now I just have to let the market play out as it's going to play out. I have covered everything from every angle, and that's all any of us can do in the investing world. It's one of those fine lines. Like you really want to protect your portfolio from getting crushed, but you have to take trades, right? So I don't think you did anything wrong when you say that. It sounds like you probably took some losses. I don't think you did anything wrong. As long as you diversified 3 trades, yeah, there's going to be times when those Iron Condors stop out on you. But the advantage to an Iron Condor, don't forget, is that they do perform better in higher volatility when they are opened. So if you get hit with something and your Iron Condor stops out, it sucks. You had a losing trade. Hopefully you have 50 trades that year and you have, a smaller than 25 number of losers. But it means your next trade is going to be stronger than the previous one, because now volatility is certainly higher. So now you get to open a new Iron Condor after you get stopped out that's going to be more powerful, much wider wings, again, 45 to 75 days out, follow all the rules of engagement, 3% allocation, stop losses. You just chain them, right? You just layer them and chain them, and you just keep going. And over time, your profit comes not from any individual trade, but from trade layers and just repeating a long-term process. It does work out. I don't know how quickly I can, I don't have access to it right now, but, actually I do. Give me 1 second here, because I wrote an article, so I can point to the website as well. A little cheap plug for my website. If you go to the blog, of course I do write a lot. I do a lot of articles, but this one here, Iron Condor Strategy Performance, all I will really say is, how did I get, I remember this, August 2017. This was rough for us. And these were live trades within the VTS community. So remember I said 350 people were here before 2016. You will remember those days. We had a 15% loss in that period. It wasn't fun. But the next trades were opened with better volatility and much better probability for success and much higher profit availability. So we took a hit, we took a 15% loss, but then it's recovered within a short amount of time because the next follow-up trades are going to be better. And I don't know if I've got it on the website. I should. But if you want to Google, or not Google, but use this search, Options 101, is that what I called it? I don't know. But there's one of these that I actually showed what happens during the financial crisis and how profitable Iron Condor trading is during a crisis. Which one would it have been? I'd recommend people watch them all. It's a 6-part series. They were written ages ago. I don't know if it's this one. But I went, to live trading. No, it's not that one for sure. Oh yeah, this is it. Iron Condors perform better in higher volatility environments. I showed that an Iron Condor opened at 18% vol, it's fine. But if you open one at 33% vol, now you've got really wide strikes, right? So this is a 16% wide trade. If volatility is low, it's only 9% wings. That's 9% up, 9% down. This one, because volatility is at 33%, now your Iron Condor has 16% up and 16% down. That's the wings. And then if you opened one during the height of the financial crisis, when volatility was 64%, your wings on this Iron Condor were 35% up and 35% down. That trade, I'm not going to say it can't lose money, but it's pretty close. I mean, that's an extremely wide Iron Condor. 35% from the opening prices, that's pretty big. So I showed that in the examples. You can poke around the website. There's a large number of articles on there. But that's a long answer, Arthur. But basically, diversification, 5-point diversification, you're going to be fine. You're going to have losing trades. We all do. You're going to have losing months. You're going to have losing years. 2022, we had an entire year where we were down. It happens, but stick to the process. Make sure you're diversified all the time, and we need to allocate our money. We can't be scared of these events. So, have you ever considered including VXX or UVIX in your Iron Condor strategy? I don't, because I think there's far better ways to use those ETFs. You could. There's nothing saying you can't. Just remember that you're going to have to lead the trade a little bit. When you're talking about SPY, I have no, on a short, say 60-day time frame for our average Iron Condor, I have no realistic expectation that it's going to go higher or lower by very much. It's basically a 50-50 coin flip. Long term, we know markets go up, but 60 days, it could go down just as easily as up. But when you're dealing with something like the VXX, UVXY, UVIX, things like this, you have to understand that you have to lead that trade. So it's not going to be centered around where the price is today. What you'd probably want to do is go ahead and crunch some numbers a little bit, or if you're a member of the community, sorry, I don't recognize all the YouTube things, but we do the VXX crush level. You can actually predict where these things are going to be in the future based on how they are calculated. So basically the VX30, the VIX roll yield, the 30-day constant maturity VX30, we can predict where these things are going to be, and we know that 86% of the time they're going lower. So it's not going to be an equal Iron Condor up and down. It's going to be, but depending on your time frame, 60 days out, VXX trading at 54 right now, you might have to center your Iron Condor at 50 or 49, 48. You definitely have to lead. It's like I always say, Wayne Gretzky. I'm good old Canadian from Alberta, so, Wayne Gretzky he's the greatest of all time, obviously. Skate to where the puck's going to be, not to where the puck is right now. That's how you do it. So you can do them. It's just I use VXX and UVXY in so many other places that I don't need to jam it into every strategy. It's, the same way I wouldn't do a Wheel of Fun like I went through earlier. There's nothing saying you can't do a Wheel of Fun on the VXX. I just don't, because I have the tactical volatility strategy, aggressive vol. I have volatility step. I have volatility trend. I've got a lot of places where I'm using vol ETPs. I don't need to jam it into every strategy I have. Here we got some comments. The funnier part is that the video has 1.8 million likes. Yeah, she said that strategy makes $1.8 million. I guess $1 for every like. That's an impressive number. It is really unfortunate that she missed the mark by 600%, but yeah. Oh, cool, my sister. 10 million views. It's nuts. Like, I've never had a video that has, I think YouTube's totally different than TikTok. It's probably a multiple of 10 or 20 at least. But I think my most viewed video is like 60,000 or something. 10 million people watched that video. I should get on TikTok. I shouldn't get on TikTok, but it's tempting to get on TikTok. And then if I go on TikTok, obviously I'm going to tell the truth, and clearly I'm going to fact check my stuff. I'm going to spend it takes 2 hours to make one, spend an extra 5 minutes and make sure it's right. So would I even blow up on TikTok? Could I even get 100 views on TikTok? Like this guy telling the truth on a platform, we have no time for that. We need somebody who's saying, all you need is $75 and you can retire a millionaire and never work again. I'm not sure if I would succeed on a platform like TikTok. Probably because they don't have credit to get the loan. I don't know how that works exactly, whether it's even tied to your credit, to be honest. I mean, I'm pretty sure your credit card company, they will extend you cash on your credit card if you're willing to take that interest rate. I think they'll give you as much money as you want, pretty much. Up to your credit limit, probably. Who would do that? I don't know. One person, clearly, he made a video about it, but yeah. Here to learn a little bit more. Awesome. Hopefully you do. Ask questions. I will, sometimes to my detriment, thoroughly answer questions. Sometimes it takes a while, but I like to give thorough answers. There's too much financial misconception around. By the way, what bottles of wine are behind you? One of them's garbage. One of them's cooking wine. I just liked it because it's a shiny bottle. The bottle of red there is one of my favorites. It's Stag's Leap, Cab Sauvignon. And the middle one is we suspect, a very good sake, but we haven't opened it yet, clearly. I'm not a wine drinker, but my wife has done level 2 sommelier already, and she's going into level 3 soon. So she's quite good with wines, and I'm still very basic. It's either good, not good. That's pretty much the extent of it. Sometimes I can tell whether it's a certain type of grape. If it's one of the main ones, I mean, I could probably isolate 5, but there's obviously hundreds or maybe even thousands. I don't know. I should ask her. But yeah, they're just there. I've told this a lot. I'm a minimalist. I don't have any stuff. Everything I own is in this room right now. All my clothes, all my belongings in this entire world fit in 2 or 3 suitcases. So I have nothing. I was looking for things to put on my shelf, and I'm grabbing speakers, and you can see I've got a GoPro up there. I've got my wife's wedding ring box. Just things that are colorful that give people something to look at. That's what the computer's there for. I have no stuff. I have no books. I've got nothing. So there you go. 3 bottles of wine. I continue to miss your notifications. Done all the required steps. I was notified while visiting Twitter. Not sure what could be. I don't know. YouTube isn't a perfect platform, and people do complain a lot about that they have the bell, they're subscribed, they have the bell notification, everything's good to go, but they still don't get notified. I would suspect it's a combination of me being less active, right? I took a lot of time off there. I'm currently building a pretty extensive options course that's taking up a lot of time on the side, so I haven't been posting a whole lot. And YouTube sometimes just either unsubscribes people randomly, the algorithm just kicks them off, or they just don't get the notifications. So yeah, if you've done everything, everybody else who's listening right now, subscribe to the channel and then click the notifications and make sure it says all. And that's the best you can do. Beyond that, if you don't get it, you don't get it. But I would say you can see it down there. You can follow me on Twitter as well. I will always notify people of live streams on Twitter. I basically send it Facebook, LinkedIn, Twitter. You will never miss anything if you just follow me on the socials. That's not a plug, by the way. Not that you need to follow me or anything, but if you want to get notified, yeah, go ahead. I'm very inactive on Facebook. I don't care about that at all, but I do post stuff. Just notifications. All right. What do I think of sentiment data, and do I use some of it myself? No, I do not. Let me see if I can just stuff in a golf analogy here, because it's been, It's been 57 minutes and I haven't talked about golf yet. So I was trying to teach my wife a lesson a few days ago when we were golfing. Don't ever watch somebody else putt, right? You never stand behind somebody on the green. Well, you can't stand directly behind them. You have to be about 3 paces to the side. But what some people often do when they're golfing is they'll stand 3 paces, and as soon as the person hits the putt, you're allowed to then walk into the line behind them, and you can see the ball roll. Don't ever watch somebody putt, because you don't know what kind of putting stroke they have. You don't know what kind of pace they usually put on it. You don't know what their spin rate is. There's a lot of variables involved. So the last thing you want to do is watch other people putt. Now, if it's your best friend and you've been playing for years and you know each other's putting stroke and speed and line, then maybe you can gain some knowledge there. But you're just never going to know if that's useful for what you're doing. So trading is the same thing. Why would I care what other people think of the market? It doesn't influence what I'm doing. I don't know what their goals are. I don't know what their portfolio looks like. No idea. It's the same thing why I never look at block trades, like the level 2 data and all that stuff. You see, oh, this guy bought a block of 50,000 options on VIX index or something. Well, I don't know if that's a giant hedge for an even bigger portfolio that's net long, or whether it's a massive speculative position on a volatility crash. We have no idea when we look at anybody else but my own brain. I can't learn anything from anybody else. So I ignore all of those things and I just trade my data. Every day I have an extensive data set that I inputted. It takes 30 minutes and then it spits out the trade signals and I analyze it all. And this is what I do. Everything can be captured within the volatility levels. I don't need to go outside of any of this. We can see anything we need to know. The relationship between the VIX 9D, the VIX, and the VIX 3M, for example. This relationship relative between each other's strikes, right? 9-day, 30-day, 90-day. Everything I need to know is there. I don't need to trust somebody else. I don't look at it, don't want to look at it. I don't watch other people putt. I don't stand on the par threes and, hey, you can't ask direct advice, but I'm not trying to figure out what iron they hit on a par three. Doesn't affect me. I got my own shot in my head. I know what I'm hitting. I don't care what you hit. So there you go. There's your token golf analogy. No, I don't follow sentiment data or anything like that. Okay. I follow your ETF strategy allocations, but I'm yet to take the Iron Condor and Vol strategy trades. One question I have is how the CAGR for IC can be 26 for last year. Assuming 3% loss per trade, roughly 1% upside, 3% downside per trade. So if we stop out profitably that 0.5% per trade, I think you're running the math on what should be an average. So if you're trying to get at what would be an acceptable average, I have the results. The Iron Condor strategy was launched in the VTS portfolio all the way back in 2012. It was one of the original 3 strategies. And we've done several other things along the way, but this is one of the longest running strategy we have, along with a few of the others that have been in the portfolio the entire time. So if you want to know what the performance is, it's not 26, it's 17.65. That was just, last year was a good year, right? This is how we got to that number. These are the monthly returns. This is what it actually ended up, 26.06% for last year. You got to remember that this isn't an individual trade because we do trade layers. So that's what each individual month, every trade that was closed out during that month gets added or subtracted if it's a losing trade to the portfolio. And these are the individual monthly returns. But 4.67 for December, for example, there was 2 trades, both winners, both of them made 2.3, 2.4%, and it adds up to 4.67. So this is not 12 trades. This is layers of more trades. But yeah, last year was a really, really good year for Iron Condors because, of course, like I said, Iron Condors do actually do well with higher volatility, and they do especially well with choppy markets. So I've had a good couple of years with that strategy because the markets haven't really been raging higher. And it's true, you do get stopped out sometimes. Like this is a violent crash, but if you get stopped out, let's say you got stopped out here, for example, you open a new trade the next day, volatility is very high, your wings are extremely wide, and that next trade is almost certainly going to make money. So you just do that over time, and there you go. You've got a strategy that can. What am I doing? I'm clicking all these things. You've got a strategy that can, in some years, make a really good return. But on average, I think what you're getting at is because we do it safe, because we do smaller allocations, is you're never going to make 50% trading Iron Condors, at least the way that I do it. I'm not trying to do that because when you take on risk, you have to understand there's always a double-edged sword. If you can make 50, you can certainly lose 50, and typically you can lose more than you can make, right? That's especially on the high end. If you have low risk, then you can probably make more than you lose. But once you cross that threshold, now you're all of a sudden taking on very leveraged trades and you can lose more than you can make. So the way that I do it, 17.65 over an 11-year track record, that's fantastic for me. I'll take that for the next 30 years, please. I'll shake your hand and take that deal. So that's kind of the range that we're looking at. Some years won't make anything. Some years it might make 20 or 30%. Kind of the way it goes. But I think when you're running the numbers there, I don't disagree with anything you've said, but yeah, you're talking about trade layers. stop gain, stop loss. A typical trade win or loss will probably be in the, the 1.5 to 2.5% range typically. So sometimes it's actually, I can show you that. It's not uncommon to see numbers of returns that seem to be hovering around -2 something, 0, +2, or +4. This is not uncommon because this would mean that there were 2 trades in these months. These ones here, I don't know if you can see that. 4.81 means 2 winning trades. 3.89 probably, I'd have to look back. It means 2 winning trades, or it means 3 winners and 1 loser. That's typically the range we're looking at. So you will actually be in the habit of seeing a lot of things that are, you can see 2, 0, 2, 2, 2, -2, +2, +2, +4. It's kind of all in that range. That's what we're looking for. It's just the way that I size my trades. Not uncommon at all. Sometimes you'll see some -4s. If you get 2 losing trades in the same month, that's a -4. You get 3 winners, that's a +6 or 7. That can happen too. We've had those. On the downside, it can stretch a little more. So you saw that -2.5. That's because when you set a 50% stop loss, there's no guarantee you're going to stop out at exactly 50. You might wake up in the morning and there was a gap down, and instead of 50, well, now you're down 60. And like I highlighted, I keep going back to this. I should have just kept it up on screen the whole time. But when I highlighted this, what ended up happening, I don't know if you were trading in August 2017, but there was a big volatility spike there. And we had one trade, one Iron Condor, 2 of them open, but one of them was kind of right on the edge of almost stop lossing out. And then we got hammered on a gap down the next day. So we didn't stop loss out at 50%. I think, if memory serves, it went all the way to 73 or 74 or something like that. It was an outsized loss. And I believe there was even 3 losses in the span of about 6 weeks, something like that. It can happen. But yeah, your math isn't wrong. I like those numbers. You are correct. Did I miss? I think I explained it wrong if you have a follow-up. I think my question is, if we allocate 3% net account value based on the downside, and the upside for the IC is 1%. No, the upside is 50% upside. The down and up is technically the same thing. Now, like I said, the down, sometimes you can get a gap up and your stop gain isn't 50, it's actually 55 or 60 and bonus, right? But downside can slide a little further. But technically on a math basis, 50 stop up and down. So let's say, just for simple math, you got $1 premium for the Iron Condor. You brought in a credit of $1. 50% stop loss means when it dips below 50 cents, you're out of that. Oh no, that's a stop gain, of course. It's a Vega positive, or Vega negative trade. Sorry. 50 cents means that you stop gained and you get out. $1.50 means you stop lost out and you're out. So technically it's the same 50 cents, but doesn't always work out smoothly. I wish it could. This is one of the reasons, again, I will say it, why we trade longer dated contracts, because you are much more likely to be able to stop loss or stop gain closer to the 50. If you're in the habit of doing, say, 2-week Iron Condors, and then you let it go for a while and you've only got 5 days left, and then the market gaps, it could go from 50% to 90. It can move extremely fast, right? That's what we call dancing on the gamma knife edge. When you get those option contracts getting close to expiration, now all of a sudden stop losses are really not very meaningful at that point. So I always keep my Iron Condors super long dated and just little wins, 50% here, more wins than losses, layer the trades, 5-point diversification. It works out really, really well long term. Might not seem like it. When you're in it, when you're in a good strategy that makes, 15 to 20% a year for 10, 15 years, it never feels exceptional. It just feels like nothing's happening here. It's really boring. Boring is good. That's exactly what you're looking for. I know that doesn't sell on Twitter, and I'm not overly popular, and I don't do ads and all that stuff. I'm the boring, safe, consistent guy. But like I said, if that deal is offered to me, I'll shake your hand and take that rate of return right now for the next 30 years, and would be very happy to do it. So I think we got through all the chat, and we've been doing it for an hour. So I'm going to close I'm going to close just on another golf analogy. And if people are wondering why I do these golf analogies, I did used to be a professional golfer. I'm not just some guy who loves to talk about golf. It's part of my life. I spent 15 years, traveled around the world playing tournaments. So I do like to do some golf analogies from time to time. Let me hit you with one right now. All right, so the first thing I like to do is just explain some aspect of golf. So hopefully we've got a few golfers. People are kind of leaving the live stream after about an hour and 10, people start leaving. But for the 39 people that are watching this, and of course, people on the rebroadcast, hopefully some of you are golfers. So obviously the 300-yard drive is what everybody's interested in, right? That's what gets the eyeballs. Everybody's, wow, 300. Rory just hit a 375-yard drive on a par 4. It's all over Twitter right now. But the truth is, by far the most important aspects of golf are, number one, far and away, mental game. Number two, putting. And more specifically with putting, short putting. So let's say 5 feet from the hole. If you can make 5-footers consistently, and good tour pros are in the mid to high 90s percentile of making these shorter putts. If you imagine what's happening, and this is why amateurs kind of suck at golf, because there's so much pressure and they think the game is so hard. But if you can make 5-foot putts pretty much all the time, like if you're 90% from 5 feet, imagine what's going to happen. If you know you can make a 5-foot putt, you don't actually have to chip the ball that close to the hole. You can just chip it 5 feet from the hole and you're still going to make your par. You don't have to chip it this far. You can chip it this far and make your 5-footer. So that means you're chipping, you can relax a little bit and you can just hit your chip shot. It's not that hard to chip it 5 feet for a professional. And if you know that you really don't have to do that either, well then in the fairway, I don't even really have to hit the green, do I? I can miss the green, chip it to within 5 feet, make my par anyway, and it's the same score on the scorecard, right? There's no pictures on the scorecard, there's just numbers, so I'm gonna make my par. And if I don't actually have to hit the green, well then I don't have to hit the fairway either. So that takes all the pressure off my driver. So now, at no sequence in this golf hole do I have any pressure. On the tee, I can just relax and let it fly because if I hit the fairway or miss the fairway, it doesn't really matter. If I hit it in a greenside bunker, who cares? I can just hit it out next to the green. I don't even have to hit the green. Just chip it on, make my 5-foot putt, and I'm good to go. But if you're an amateur golfer that can't make a 5-foot putt and you have to get it within 2 feet in order to make that par, well, now your chipping has a lot of pressure, and you're not going to be a good chipper if you're chipping under pressure. And if you know that you have to chip it this far away to make par, well, then you better hit the green. So that means your iron play has a lot of pressure as well. When you're standing in the fairway, you better hit that green, and you're not going to hit a good shot if your shoulders are tight and your pressure. And again, going back to the tee, you better make sure you're not in a fairway bunker or you're not in the deep rough because you're not going to be able to hit the green. So now your driver has a lot of pressure as well, all because you have to hit it this far to the hole to make par. But if you can do it here, it relaxes the entire process of golf, and you can play like those people you see on TV that seemingly just step up and just smash it as hard as they can. That's because there's no pressure, because every good player can make those 5-foot putts. There's no pressure. It's all the way back to sequence. So investing is the same thing. This is the analogy that if you go on Twitter and you go on all these YouTube and TikTok, just cesspool of nightmarish videos people are making, what is everybody talking about? The big wins, the big profit. Watch me make 3,000%. This, whatever it is, it's all about 300-yard drives and getting eyeballs, right? It's about the big profit. But the truth is, the most important part of investing is the risk management. That's the 5-foot putt. As long as you have risk management in place, you're diversified with your portfolio, you've got stop losses, you've got allocation size that's within your risk tolerance, and you're not going to get into trouble if you have a Volpocalypse event or something. As long as you put that risk management in place, which is the analogy of the 5-foot putt, then everything you do in your portfolio is relaxed, and you can just trust the process. You can just do what I do. You log in every day, you check the volatility metrics, you enter the trades, you do it without emotion, and you just let the whole process fly. I just stand on the tee and grip it and rip it, they say. That's what you can do if you're good at risk management. But if you have no risk management, Now you're going to be in a situation where you're taking outsized losses every now and then, and you're going to need to put on more and more risk to make bigger and bigger profits to recover from all those times that you screwed up, right? You're going to have a monster year next year because you did stupid things this year. That's the analogy, is that as exciting as it is to have a big month or a big winning trade or a year where you can say, I made 40% this year or 60%, as exciting as that is, you will make the most money long term if the very first thing you do is consider risk management in every trade, in every strategy, in every portfolio. That's your 5-foot putt. You need that in place. And trust me, when you get it, everything else feels easy. A lot of people ask me questions at VTS, like, aren't you nervous about this event coming up? What's going to happen with the SVB banking crisis? What if there's a Volpocalypse event? I get that question every live stream. My answer is kind of the same because I'm so relaxed and confident in my risk management that is in place already. I've got a fully diversified portfolio of multiple strategies, each one of which has its own risk management in place. What am I worried about? I just log in, take my trades, and move on with my day. Get back to my spreadsheets, get back to making another video, where in my world of making videos, I actually fact check them. So that's what I would do if I have risk management in place. Without it, wild, wild west, you don't know what's going to happen, and it's a nightmare. So that's your token golf analogy. It's surprising. A lot of people wonder how I transitioned from a pro golf career to an investing career. And I'm right at that stage where I was basically golfing from age 15 to age 31, right? I basically retired at 30, played a few tournaments. So let's say 31, 16 years. And I started investing basically in 2005 when I retired from golf. And it's been 17 years. So I've had two careers, one 16 years, one 17 years, seemingly polar opposite careers, but surprisingly very similar. I don't know really how to explain it. That's what these lessons from the links are, that over time, I think you'll understand that the similarities between managing a professional golf career and managing a portfolio, you'd be surprised how many interesting, valuable lessons I carry with me from my pro golf days. Very useful. And it's not just golf. I mean, I don't know if you've noticed, but there's a lot of athletes, former athletes, pro athletes that do succeed in the business world. They do succeed in the investing world. I think that's because what is required to become, I mean, once you get to a professional level, you're talking about the top 0.001% of players, right? We're not talking about getting in the top 1%. We're talking about so few people, like you're down to hundreds in the world. There's a lot of valuable lessons in that process building to that point that you could carry with you to anything else. So I've had two polar opposite careers, and it is interesting. I've crossed that line where I'm now more of an investor than I am a golfer. 17 years. Launched VTS ages ago. And I posted my results online publicly for 2 to 3 years before I launched VTS. So 13, 14 years of public track record. It's pretty cool. I guess eventually, unless I switch careers, I could switch now. I'm 47. I guess when I'm 63 years old, I will have 3 careers, each of them with 16 to 17 years. But no, I'm not going anywhere. Don't worry. All right. I'll answer 1 or 2 more, and then we will wrap this up. It is 1:20 in the morning for me. I'm back in Taiwan, so markets open at 10:30, close at, 4 or 5, something like that, depending on daylight savings time. Now I'm a night owl because I'm in Taiwan. Because the Iron Condor wins more than it loses. Oh, you're answering somebody else's question. He opens the short legs at 15 delta, which roughly translates into 85% chance of success. 70%. Both sides. But yes, correct. His math was decent. It's just, I think the missing element was, and maybe I didn't spell it out completely correctly, but there's more than one trade in each one of these months. So it does seem like quite a stretch to make 4.67 or 4.81. But if that's 2 winning trades and 0 losing trades, or 3 winners, 1 loser, then yeah, you can get to those numbers. So, but thanks. I love when people are chatting and helping each other out in the chat section. I think that would be really cool. We've got a lot of regulars. I see the same names constantly. Yeah, it's pretty cool. Have you ever played Doral? No, I haven't. I've played a lot of the famous courses, of course, but no, never played Doral. The Blue Monster. Nope. Would like to. The problem is there's just so many legendary courses that you can't play them all. You know, I've played Pebble Beach. I haven't played St. Andrews. I've played, obviously, I could never play the Masters, but I've played, you know, Pinehurst. I've got some of them. I've checked them off the list, but you'll play forever. You know, I've played Oakmont. I've played Bethpage Black. So a lot of the tournaments that you see on TV, at some point in the past, I either played a tournament there or one of my, you know, friends invited me out to their course, something like that. There's a million that I'd love to play. And now that my wife's golfing as well, I shouted her out in the last live stream, but I'll do it again. She broke 100 for the first time, and she's only been playing for a little over a year, and she shot 97. So she broke 100, crushed that number, 97 easy. But now that she's playing, we get to play more courses. As an example, Banff Springs, I was born in Calgary, Alberta. I lived there for 20 years. I actually never played Banff Springs, which is one of the best courses in the world. And I think it's ranked second now in Canada. I think Cabot Cliffs is number 1, but I think Banff Springs is still number 2. It was 45 minutes from my house, and I never played it once. And then because of my wife, I took her on a road trip to, you know, the Rocky Mountains and Lake Louise, Lake Moraine, all these places. And we played Banff Springs and Silvertip, and we got all these cool courses. So now with her playing, she mentioned last time she wants to go play Scotland. She wants to go play St. Andrews. And I would probably get her to go to Ireland instead, because I think it's a cooler vacation, but also fantastic courses in Ireland. There's the Ballybunion that I would want to play, and there's a bunch of them. So too much golf today. So next time, remember that email address. I put it in the chat there, volatilitymatters@gmail.com. Make sure if you ever see a TikTok that you think is just hilarious, and especially if it's investing related, and we would love to start getting some VXX, because I know they're out there. I know that there are people saying, you know, just massive misinformation about volatility ETPs. There's got to be, right? Send them to that email, and kind of every live stream from here on out, I would like to do some type of social media fails segment, at least 10 minutes, because those are pretty fun for people to hang out and laugh with me. Because I watch them, people send them to me, I see them in my Twitter feed. If I'm going to be punished watching them, I'm going to make you guys watch it as well. So send those to me. That'll be a lot of fun. And thank you. Next live stream, I've got a good one planned I'll tease it a little bit for the few people that are left here. I'm going to divide the volatility market into deciles, which is, of course, 10% along the way from 0 to 100 percentiles, deciles, so 10 of them. And we're going to isolate when volatility, the short vol trade, actually performs the best. And so I think anybody who's a volatility trader, a volatility ETP trader, I think you're going to want to tune into the next live stream. So probably next week, but I might do them every 2 weeks. If I notice the number of questions are dwindling, then maybe my popularity is dwindling, and I will do them every 2 weeks. But follow me on Twitter. You'll see the notification. And thank you, everybody. I will see you next time.